over to you. And let me just, if you can start us off with what are the things that folks should be thinking about so that they can reduce their taxable income?
Reducing taxable income. We actually get that question a lot with the planning that we do with our clients. They ask things, especially this time of the year, new year, going into the tax season, like what's changed? What deductions am I eligible for? Randall mentioned like a lot of folks, how can I lower, my taxable income this year? I have a new job, a life event, whatever that may be. And really, there are three main ways. There are others, but there are three main ways to reduce your taxable income. So let's go through those three. The first would be to start by maximizing those retirement contributions. And so we have a slide here up on the screen. And as you can see on the slide, it's a pretty big number you could potentially contribute. People who have access to a workplace plan like 401k or 403b, they can contribute up to $23,500 this year. You can also contribute $7,000 if eligible to an IRA. Those who have a SEP IRA can contribute simple IRAs. There's a lot of different ways. And then the great thing is if you're over 50, you can make additional contributions. We call those catch-up contributions. So another way you can reduce your taxable income is to consider an HSA if eligible. And I love the HSA. And we will talk a little more about HSAs here in a bit. But if you're covered by a high deductible health plan, you can contribute up to $4,300 for yourself or up to $8,550 if you have coverage for your family in 2025. Again, here, those over 55 can contribute an additional amount. A third way, and one of my personal favorite ways of lowering my taxable income is through charitable giving. So you can donate cash, investments, you can even donate physical property like a house, a car, or even some of the items in your home to get a potential tax deduction. Now, as you can see on the screen, the limit depends on what you give between that cash or the non-cash or investments that are appreciated. So you can see those there on that slide. Here at Fidelity, we also like to talk about a strategy we call bunching. And what that word bunching means when it comes to charitable giving is, let's just say you give every year. But maybe this year you got a huge bonus or some influx of income and you have higher income this year than you would say in the future or you do normally. You can take the next 3 years, the next 5 years of your charitable giving and give them in this year to potentially have a higher deduction this year. So it's a really great strategy. Now, one thing to note, in order to be eligible, you actually have to itemize your deductions and you have to donate to a qualified charity. If you're interested in charitable giving, we often ask our clients to consider checking into Fidelity Charitable, one of my personal favorite accounts that we have here. It's a public charity that helps anyone who's wanting to donate to maximize their generosity through a donor advised fund. You know what? I forgot to mention one more. There's another option to lower your taxable income, and that's actually, I just mentioned it above. You can itemize your deductions. The IRS says that 90% of taxpayers choose the standard deduction. So 10%, only 10% actually take advantage of itemizing your deductions. But if you spend a lot on healthcare, if you've paid a lot in state and local taxes, or you just have a lot of items that you can itemize, it might make sense to itemize for you. So again, just like Randall says, work with an experienced tax professional to ensure you're taking advantage of all the deductions that you're eligible for.
Very helpful. And that the fact that 90% of taxpayers actually choose the standard is fascinating. So really good for us all to think about doing a bit more and itemizing if we're in a situation that may get us to a greater potential tax savings. So thank you so much. So one of the big questions that comes in, and I know, we talked about taxes, we're not actually giving tax advice. That's someone obviously we should go to, but how do we know what to do or who to call for what question? So do we call a financial professional or when do we call a tax professional? Randall, can you just walk through that so everybody knows which path to take?
Yeah, and just building a little bit on what Felisa said is like, these different tax professionals are part of what I sometimes refer to as your financial dream team, right? But it's important to know where to get help for what, especially when you're thinking about finances and taxes. They're constantly overlapping and people often have distinct roles. So let's take a look at this a little bit more. A tax professional. We typically think about a tax professional during tax season when it's time to file and prepare our annual returns. Important though, their expertise goes way beyond that. They can provide year-round guidance on specific tax questions. For example, is my charitable contribution eligible for a tax deduction? Should I itemize, right? Tax complexities like I own multiple properties. What credits or deductions am I eligible for? And we're going to drop a tool from the irs.treasury.gov that allows you to find people that help with preparation in your area. You can consider looking for different credentials that tax people have, like CPAs or tax attorneys. Essentially, you want a specialist on the tax codes, and they can help you apply those codes to your personal situation. Now, on the other hand, you have a financial professional. You might be a little bit more familiar with this. It's like the teams that me and Felisa work with. These are people who help you with your big picture financial health. Savings, investing, handling emergency, paying off debt, and things like that. Taxes are this piece of the puzzle that happens constantly with all of the financial decisions that we make, and things that you decide with your financial professional could have tax implications. So we can help make sure that your strategies are tax smart, and you can even sometimes hire a financial professional to deploy tax smart strategies for you, often for a fee. But we don't file your taxes. So we're here to help create a proactive plan for you so that taxes don't catch you off guard. But when it comes to specific questions, that'll be for a tax professional. And I know this can involve a little complexity, so let me say this. You may have different financial professionals that have credentials where they provide tax advice and vice versa. But when it comes to making that first step to clarify who you should talk to, you shouldn't overthink this. Oftentimes, the first step is giving us a call, and we can help clarify what the next step is. But just the bottom line, if it's filing your taxes, understanding deductions and credits and tax-specific issues, tax professional. If it's about planning for the future, managing your accounts, strategies, financial professionals.
Very helpful to have that distinction. But Randa, what I appreciated even more, and I personally just had this experience where I had to call Fidelity. What I think is so great is there's clear direction about like what you all can help on working with clients one-to-one every day versus when you really need to engage a tax professional. And the person I work with did such a wonderful job with that. So I love the idea of also, we don't know and we ask, you all can help us, give us the right direction as to where to go. So I love this audience, that group that is chiming in the chat, because there's such a good set of questions. And I want to continue on this path of, the smart, I'm going to call them tax smart investing moves that they can make. So Felisa, and Sharon asked this earlier, there's some recognition, obviously, of, she called it the 401k, but, utilizing a retirement or an employer retirement account. What are some of the other tax advantaged accounts that we should be considering outside of our employer retirement account? Few folks also asked about really understanding HSAs more deeply. So Felisa, if you could cover off on that, that'd be great.
Sure, absolutely. Let's talk through some of those other types of accounts. I love what Randall just said just a while ago. She said taxes are a piece of the puzzle. I love that, because taxes is what we're talking about here, shouldn't be the primary driver of your investment strategy, but you absolutely need to take advantage of opportunities that are designed out there to help you manage, help you defer, and help you reduce taxes. So you can keep more, right, of what you have and what you're making. So different investments tend to generate different levels of tax impact. And we're going to dig more into tax smart investing a little bit later, but let's talk about those different accounts. Let's start with the one you just asked about, Lorna, HSAs. I love the HSA. And I think a lot of financial planners and advisors will tell you they love the HSA. And why is that? It is the one account that is triple tax advantaged. And you're all asking me, what do you mean by that? What is triple tax advantage? There's very few things that are triple tax advantage. So first, your contributions, we talked about this earlier, reduce your taxable income. Second, your contributions are not taxed. So when the money's in your account, in your HSA, and it's earning interest or investment returns, you don't pay taxes on it, right? It's sheltered within that HSA. Third, you won't owe taxes when you withdraw from your HSA as long as you use that for qualified medical expenses. So triple tax advantage, only account that does that. Your money is also always your money. So if you change jobs, if you move states, if you change your health insurance, that money is your money. The other really great thing about an HSA is that once you reach the age of 65, it can act like a traditional IRA. Meaning you can withdraw from it for retirement items like retirement expenses. Maybe you want to travel in retirement. Maybe you want to buy a boat. I don't know. But the great thing is there's some flexibility there after you turn 65. You don't have to just use it on qualified medical expenses. Catch there, though, is that you will have to pay federal and state, if applicable, taxes on those withdrawals. The last thing, and I think the greatest part of the HSA on top of the triple tax advantage, is you can invest the funds in there. It can stay in a core money market position earning some interest, or you can invest it and make the most, right? Get the potential to earn even more on that triple tax advantage account. The other account we want to talk about is a Roth IRA. And a Roth IRA, the main perk about this, and I think a lot of us out there know it, is tax-free withdrawals in retirement, tax-free withdrawals in the future. And no required minimum distributions. And if we have time, we'll hit on required minimum distributions as well. So what this means is that when you put money in a Roth IRA, that's when you pay the taxes, right? Pay the taxes on your contributions versus when you take it out in the future. Once you have an established Roth IRA, here's another great thing about the Roth IRA is once you have it established, and the good news is as long as you've held that account for 5 years, you have access to the contributions. You can actually draw those contributions, not the earnings. The earnings you don't want to touch. But the better news is when you reach 59 and a half and you're able to withdraw from that Roth IRA, both of them are tax-free. So it's a great account. Those are both two wonderful options.
I love that you covered that in such detail, so thank you. It's also nice to see that as we get older, there are some really positive things that are set up for us to really be helping kind of them make the most of our money. So thank you for covering that. And I want to continue on this conversation because Monica asked about converting actually her existing 401k to a Roth IRA. And if we can just cover overall, when should someone consider doing this? Why might that be a good idea? And then, how can I calculate it to understand it? Randall, let me come over to you to get some help with that.
Yeah, a Roth conversion is when you take money from you just mentioned a 401k or traditional IRA and you convert it into a Roth IRA. That means you're taking your pre-tax money and funds and you're moving them to a post-tax account. You'll need to pay taxes at the time that you convert that money into a Roth IRA. And you'll often hear out there these terms like backdoor Roth or mega backdoor Roth. That kind of goes into that sort of strategy. And conversions will be appealing to those who either make too much money to contribute directly to a Roth IRA, since Roth IRAs have income limits on contributions, but conversions don't have income limits at all, right? Or maybe you just want the tax benefits to pay the taxes now versus later. Like maybe you're anticipating being in a higher tax bracket later. Maybe, like Felisa referenced, you don't want to pay RMDs, whatever it is. There are different strategies to get money into a Roth IRA account. But keep in mind, again, with a conversion, you're responsible for paying those taxes that you convert on. So if you think about time, it's often a good idea to consider converting earlier in the year from the saving standpoint, because it gives you more time to save to pay those taxes around the next year. So just keep that in mind. And there are a lot of little nuances and timelines, like Felisa referred to the 5-year rule. So it could be useful to talk to a financial professional or tax professional if you're not sure, because you want to avoid paying any unnecessary penalties or taxes with conversions. But that's conversions.
So this is a really popular question. So thank you for answering it. And I know that you talked about, listen, there are some things that you need to be thinking about to ensure that you're making the right decision for you. And you mentioned about calling. The reality also is that we have a green button that you all have access to where you can reach out to set up, have someone call out to you. And this is a perfect example of having someone from Fidelity reach out to you to help you best understand, given your individual situation, what to do. And so if you just fill in that information within that green button, again, don't post it in the chat, but use that green button, we will then reach out to you, understand what your needs are, and then make sure to be working to either address your questions or set you up with someone for a longer term relationship. Just so folks know, it probably takes us between 5 to 10 days to reach out to everybody, as there has been so much interest. And I just wanted to make sure that you know that. But I think this was just such a perfect opportunity as one reason why reaching out now and having us having us give you a call makes sense. So I'm going to continue on this. And I think it was Felisa before who mentioned something around manage, defer, and reduce, which just caught my ear and I think really important. Can you elaborate on that a bit more? And what does that mean in terms of someone like me or any of the folks that are listening, their financial plan?
Absolutely. So manage, defer, reduce. What I love about that is it's catchy. It's easy, right? It puts things in buckets, right? Or puts things in a framework. And we use this framework: manage, defer, reduce, to incorporate tax strategies for your plan or as you're planning. So let's hit on those. So manage, that is just what it sounds like. Managing your investments with taxes in mind. It's also very specific to taxable accounts like brokerage accounts. Simply put, the decisions that you make, when to buy, when to sell, and even the types of investments you're invested in can impact your taxes. Now, you can choose to do this yourself. You can decide what to buy, what to sell. You can do the research. It does take time. And then obviously make the timing of when to sell the investments and how to switch up that strategy. You also can hire a professional to help you manage your investments for you. At Fidelity, we have a tax smart approach within our managed account offerings. And you can see, we've pulled up a slide here. We apply some of these tax smart investment strategies throughout the year versus waiting at the end of the year. For those clients who choose to have a managed account, we can employ a number of these strategies on your behalf. And you can see there's quite a few on the slide. In the past, I've had clients, when we've gone over the different strategies, the different ways that we can do this in a portfolio, they've said, I just didn't realize you did all of that. And of course, I say that's what we do behind the scenes for you. So you can help have your money work harder for you, or you can keep more in your pocket, right? Of your after your net returns in the future. So we're going to pull up another slide here. And I got to say, I know it's a pretty busy slide, but I do love this slide because it gives you a visual of the difference of implementing tax smart investing strategies in those, brokerage type accounts. Over time, your net return, right, your potential return when you incorporate some of these strategies can really be completely different. And so just know within our professionally managed accounts, we can implement those strategies on your behalf so you're confident that it's being handled. So manage. The second is defer. We actually already talked a lot about defer without actually calling it out as defer. But think of this section as your retirement accounts, your 401ks, your 403bs, your IRAs, and any other tax deferred accounts, even the HSA. Deferring your taxes may help you grow your wealth faster because you're keeping more of it invested, potentially growing. The last one there, reduce. And we already talked about ways you can reduce your taxable income. These three concepts together, when we sit down with clients, how are you managing, how are you deferring, and how are you reducing your taxes? This helps you to prioritize taxes as part of your overall financial plan.
Wow, that was a lot, but really, really helpful. So thank you. And I want to really continue on this topic because helping folks understand and also some of this terminology that we utilize. So Randall, I'm going to come over to you. One of the big words I feel like I've heard for years, and even myself years ago did not know, was tax loss harvesting, which seems it's just harvesting. What does that mean? And so can you talk about what it is and is it included in Fidelity's tax smart investing approach?
So yes, tax loss harvesting is definitely one of those strategies that we employ on your behalf in certain managed accounts for a fee. But tax loss harvesting, it allows you to sell investments in your account at a loss. Remember the capital gains and capital losses I was talking about earlier? So you sell them at a loss and then use those losses to offset the gains elsewhere in your portfolio. And what those do together is reduce your tax liability, either in the current year or in future years. And what that means, the end result, you keep more of your money and hopefully more of that money grows for you and stays invested longer, working hard for you to reach your goals. And I like to say this here. So it's not about what you earn, what you keep matters most in this situation. So this is just another way to think about strategies in your overall picture as a tool to help you reach your goals.
Very, very helpful. And I appreciate it's something that you can do on your own, but that you shared that it is also something that Fidelity does provide. And I think for many of us, we're busy and we've got a lot of priorities, but we want to keep as much as what we've earned. And so I think that is a really important point. So let's kind of continue going. And we've got a number of folks who are nearing and or in retirement. And we're talking about tax smart investing for the present day. And we've hit that, but let's really talk about now tax smart strategies when it's associated with withdrawals as we think about for the future in retirement. What should someone be thinking about as they either approach retirement or are now in retirement? Shout out to many of you who are saying they're in retirement now and thinking about this when it comes to withdrawals. Randall, I'm just going to come right back over to you because I see you smiling, so it seems like it's a topic you want to cover.
Yeah. I think about two things with retirement. Like I'm done working and then I don't have a paycheck anymore, right? So it usually means that you have to start withdrawing from your savings accounts. You have different retirement accounts, HSAs, investment accounts, etc. And oftentimes people need help figuring out which account to withdraw from. Sometimes that could be a difficult decision. And this is how we can help build the right strategy for you. So if you think about all the different tax implications of those different accounts, that could have a really big impact on how much your money lasts for you. So we'll talk about that in a bit. But generally speaking, Fidelity's rule of thumb for withdrawing in retirement is that you withdraw no more than 4 to 5% of your savings and investments in the first year of retirement. You can consider increasing that and hopefully your investments grow to keep up with inflation over time, but that's our rule of thumb.
Thank you. I'm going to shout Lisa J. I know you've been patient asking a question around what is the best strategy for taking distributions at retirement, and you listed a whole bunch of different accounts that you have. So for Lisa, I'm going to come over to you. How should we be thinking about which account to take money out first? Should we be planning for one account or multiple accounts at a time? Help Lisa J. and the many, many, many people who also wanted to hear more about that.
A withdrawal, if you're withdrawing, creating an income plan for retirement, how to take those withdrawals, what accounts. It is a lot. That's why we recommend sitting down with a financial advisor to think through like what does my withdrawal strategy look like, or what does my income in retirement look like. So what you got to start first with, we got to understand first, we need to break down your accounts and how withdrawals may be taxed from those accounts. So we break it down into 3 categories. The first taxable accounts. These are your brokerage accounts, your investing accounts. And you may have to pay capital gains tax depending on what you sell to take those withdrawals from these types of accounts. The second types of accounts are your traditional accounts. Those are your employer retirement accounts, your 401ks, your traditional IRAs, your rollover IRAs. Here, you'll likely have to pay income tax on those withdrawals.